Welcome, curious minds, to the deep dive. Today, we're not just looking at policy docs. We're watching something unfold, almost like a game. Imagine you're at a cricket match, maybe in Ahmedabad. It's tense. Your favorite batsman is almost there, century in sight, and then suddenly the umpire just throws in a couple of extra overs, but only for one team. Feels a bit off, right? A sticky wicket, you might say. Well, that feeling, it's kind of the lens for looking at a recent rule change that's really shaken things up in Gujarat's cooperative banking world.
Oh, absolutely. It's a significant shift, happened August 1st, 2025. An amendment to the Banking Regulation Act kicked in. And this isn't minor stuff. It basically extends how long cooperative bank directors can serve continuously. We're talking about the ones who aren't the chairperson or full-time directors. Their term limit went from 8 years up to 10. So, yeah, 2 extra years, a bonus innings, like you said.
Yeah. And the immediate impact, especially in Gujarat, is pretty staggering. It's like a sudden lifeline for, well, over 1,000 directors who'd already hit that 8-year ceiling. Just to give you the numbers, 169 directors across 16 district, central, and state co-op banks, plus another 876 and 145 urban co-op banks, all suddenly back in the game. So what we really want to dig into today, what this deep dive is about, is this question. Is this smart strategy? Keeping experienced people for stability. Or is it? Well, politics dressed up as policy. We're going to try and unpack both sides for you.
Definitely. And to really get why this matters so much, you first need to understand what cooperative banks are. They're different. They're kind of the unsung heroes, you could say, of India's financial system, particularly at the local level. Think less, giant corporate bank branch, more like that essential local chai stall everyone relies on. Because these banks are owned and run by their members, people pool their money together to lend it out. And crucially, it's one member, one vote. Very democratic. The focus is supposed to be on mutual help, community benefit, not just pure profit, banking for the people, by the people. That's the idea.
Exactly. And they fill a huge gap, don't they? When we talk about reaching everyone, financial inclusion, these banks are right there on the front lines. Like if you're a farmer out in rural Gujarat needing money for seeds, or maybe a small shop owner in Surat wanting to buy more textiles, often the cooperative bank is your go-to, maybe your only option sometimes. They step in where bigger banks might not see enough profit.
And they've been doing this for a long time. This isn't new. The cooperative movement in India, it has really deep roots, goes all the way back to the early 1900s. It was inspired partly by what was happening in Europe, communities trying to fight back against exploitative moneylenders. The first big step was the Cooperative Credit Societies Act in 1904, specifically aimed at getting cheap credit to farmers stuck in debt cycles.
Right, and then just a few years later, 1912, another act broadened the scope, allowed for more than just credit societies. After independence, they became, well, fundamental to rural development plans. There was this big Rural Credit Survey Committee in '54 that really pushed their importance. So it's a really rich history. Started simple, mutual help, and grew into this huge network.
In Gujarat, with its entrepreneurial streak and strong community ties, it was perfect ground for cooperatives. They really took off here. You see it everywhere. Take the Ahmedabad District Cooperative Bank, the EDC Bank. It's a major player in farm finance, got a board of 27 directors.
Yeah, and then there's the Gujarat State Cooperative Bank, GSC Bank. Ajay Patel is the chairman there, a very prominent figure, politically connected to. That bank's deposits are huge, thousands of crores, and they've been pushing digital banking hard. Gujarat has, over 200 urban cooperative banks and loads of rural ones. Billions in loans every year. They fund everything. Milk co-ops like Amul, obviously, but also just regular credit needs in towns and cities. If you're in Gujarat, you interact with the system probably without even thinking about it.
But here's the twist, or maybe not such a twist if you follow local politics. These banks, despite their community focus, are deeply intertwined with the political scene. Especially in Gujarat, they've often been sort of battlegrounds for political control, particularly for the governing party. Getting onto a cooperative bank board, it's not just about finance. It's about influence, power, controlling local capital.
It's a known thing, isn't it? A way to reward allies, keep them plugged into the system. Which brings us right back to this amendment, the extra innings. So the rule itself, Section 10A2AI of the Banking Regulation Act, 1949, it used to say 8 years max for these directors. The idea originally was to stop people getting too comfortable, too entrenched, keep fresh perspectives coming in. But now it's 10 years, a 2-year bonus, especially handy if you just hit that 8-year wall.
Right. And the official line from the finance ministry, they call it a reform.
Hmm.
They point out that the RBI, the Reserve Bank, now has stronger powers. They can disqualify unfit chairpersons or even redo entire boards if needed. So the argument is this longer term is okay because there's stricter oversight now.
But not everyone's convinced by that framing. There's quite a bit of controversy. Shakti Singhal, the Congress MP, was very blunt, called it less a reform, more a political shield. He basically said it looks like a double standard. Directors linked to the ruling party get to stay on, maybe others don't, and the timing. I mean, right when over 1,000 directors were about to term out. What do you make of that? It's just coincidence.
It does make you wonder, doesn't it? And it plays right into this concern about board capture. That was the whole point of term limits in the first place, to stop situations where directors are maybe more focused on their own networks, their own interests, than on running the bank soundly. So, yeah, the critics are saying this just lets powerful fighters dig in deeper, maybe rig the game a bit.
And it's not just theoretical fear. We've seen what can happen.
Exactly. You can't forget Madhavpura Mercantile Cooperative Bank back in 2001. That was a massive 1,200 crore scam. Billions lent to one stockbroker, Ketan Parekh. And the directors' close ties, their lack of oversight, was central to that disaster. People lost everything.
And even recently, 5 Gujarat co-op banks got penalized, right? Fines up to 5 lakh for KYC issues, deposit rule problems.
Yeah, so the worry is extending terms could make those kinds of risks worse. More time for conflicts of interest to develop, less chance for proper scrutiny. And this isn't just a Gujarat issue. It mirrors what we see nationally sometimes. Cooperatives becoming power bases. Think about the PMC bank fraud in Maharashtra, another huge one, over 4,000 crores. Deep political connections were right at the heart of that collapse. So when you see this amendment happen, just as 1,045 directors in Gujarat were hitting their limit, well, it's hard not to see the political angle.
It definitely feels like a move on a larger chessboard. But okay, let's look at the other side, because there's another argument here. The people supporting this change say, look, experience matters, especially in banking.
That's the core argument, yes. In a sector that sometimes faces challenges, like non-performing assets or NPAs, having seasoned directors can be really valuable. People who understand the complexities, who've navigated tricky situations before. They argue these experienced hands make better decisions for the bank and its members.
Like having a veteran captain who knows how to handle pressure.
Precisely. And they point out that actually Gujarat's cooperative banks overall have relatively low NPAs compared to some other places. GSC Bank, for instance, boasts a net NPA of basically 0.00%. That suggests pretty sound management. And proponents would link that stability, at least partly, to the experienced leadership they already have. It's not just general experience, it's deep knowledge of local economies, farming cycles, specific industries, stuff that takes years to learn.
And then there's the continuity point too, right? Especially in rural areas.
Yes, that's important. Frequent changes at the top can really disrupt things. Ongoing projects, relationships with borrowers. If you're constantly swapping out directors, especially in places where finding qualified replacements might be genuinely difficult, you risk instability. So keeping experienced people can mean smoother operations, consistent strategy, maintaining that long-term trust. Imagine managing big farm finance projects with new leaders every few years. It's a solid case for stability.
Okay, so let's zoom out a bit. How big a deal are these cooperative banks in the grand scheme of India's economy?
Oh, they're huge. Absolutely crucial. They are the foot soldiers of financial inclusion. They serve something like 70% of rural India. Across the country, you've got over 1,500 urban co-ops, thousands of rural ones, holding around 21.6 trillion in assets. That's roughly 10% of what the big commercial banks hold. It's significant.
And in Gujarat specifically, they're pillars of that 20 lakh crore state economy. They're vital for MSMEs, the small and medium businesses, and for agriculture. Key players in that whole vibrant Gujarat story. And you have groups like the Gujarat Open Cooperative Banks Federation pushing financial literacy, trying to uplift communities through cooperation, that Sahakar Se Samriddhi idea. So this amendment touches millions.
Absolutely. But, despite this vital role, there are still vulnerabilities. We mentioned past scandals, but there are also challenges with mergers sometimes, even cybersecurity threats like ransomware attacks hitting some banks recently. And there's still this issue of duality of control. The RBI regulates the banking side, but the state government handles registration and administration.
The two-headed cow analogy you mentioned earlier.
Exactly. It sounds efficient, maybe, but in practice it can lead to confusion, maybe slower responses to problems compared to a bank under single regulation. For the customer, that might mean less agility, maybe some services lagging.
And looking forward, other challenges too.
Yeah, definitely. High NPAs are still a problem in some rural cooperative banks, even if Gujarat overall is better. Getting technology fully integrated, like core banking systems, is an ongoing task. Plus, they face more competition now from small finance banks. The RBI is trying to manage this with that four-tier regulatory system for urban co-ops, tailoring rules based on size. So it's a constantly evolving landscape.
Right. So wrapping this up, it really feels like this 10-year extension. It's a classic double-edged sword.
I think that's fair. On one side, potential for stability, leveraging experience, keeping knowledgeable people at the helm, that could be good. But on the other side, the risk is real. Risk of entrenchment, political influence, overriding good governance, potentially weakening these crucial institutions from within.
And for you listening, whether you're that farmer making a deposit or the small business owner needing a loan, what does it all boil down to? It really comes down to trust, doesn't it? Trust that these directors, with their extra time, will use it to build stronger banks, serve the community better, or will it just be about holding on to power?
In the end, like that cricket match we started with, fair play is what really matters. Balanced governance, transparency, decisions made for the community. That's what wins.
Because ultimately, cooperative banks are about community, and every community deserves a fair pitch.
Thanks for joining us on The Deep Dive.